Hi, I'm Tom Lydon, editor of ETF Trends here in Washington, D.C. at the Charles Schwab Impact Conference. And I'm here with Joanne Hill, Head of Investment Strategy at ProShares. Joanne, thanks for being with us.
Great to be here, Tom. Thanks.
It's kind of exciting times.
Right.
I mean, equities hitting new highs, but we've got a fear on the horizon. We've got this interest rate headwind, rates are rising. Advisors are concerned.
Right, yes, and there's so many cross currents now in the fixed income space. You know, many advisors have increased their weighting to fixed income over the last several years to control their exposure to equity risk. And now the corporate sector is actually quite healthy, so it's a very good time to be taking credit risk and looking for returns, especially from long-term credit risk. But yet we have this tapering looming, and
right.
It's not if, it's when. And so people are, trying to modify their portfolios and look for solutions that will help them get exposure to the improving economy without a lot of interest rate risk.
Well, talking about solutions, that's
right.
something that you folks specialize in. I mean, yes, inverse and leverage is one thing, but really ProShares is getting to be known as kind of the alts ETF shop. And you have really engineered some great strategies within ETFs, and some specific to kind of battle rate risk, right?
Right. And we really kind of put our heads together and said, look, we have these inverse funds on fixed income, TBT, TBF, and PST. So how can we make it easier, more capital efficient for people to manage their duration risk? Mm-hmm. So what we've done is we've packaged inverse Treasury exposure with high yield and investment grade. So in May we launched HYHG, and just last week we launched investment grade, IGHG. And what we're trying to do here is create funds that have zero duration risk. Every month we rebalance to hedge the interest rate exposure to treasuries using treasury futures, just like we do in TBT and TBF.
Yeah.
But you still get, on the long side, the returns from taking either high yield or investment grade credit risk. And the real benefit is this is much better than shorter duration or floating rate fixed income ETFs, because you've got that more greater upside from longer term credit risk.
So if I can get this right and help me walk it through, so it's got the long investment grade or long high yield component.
Right, very good quality.
But set maturity.
Right.
Okay.
Very long, good quality, high yield index and investment grade indexes from Citibank with liquid issues, no concentration, no more than 3% from any issuer. Right.
Okay, and then short treasury to be able to fight off against the rising rates, which, as we know, treasuries are in a much worse position to get hit in that area, right?
Right. So your typical high yield ETF like HYG or J&K would have a duration of about 5 or 6, and an investment grade ETF might have a duration or sensitivity to interest rates of, say, 10 to 12 years.
Right.
So what we've done is we've used these treasury instruments on the short side to take that duration down to 0. And it's rebalanced monthly to go to 0. So you get just the credit risk aspect of a good investment grade and high yield index.
And as always, I know when you folks are engineering product, there's a lot of testing that goes on. And I know you've got months or maybe years of testing to be able to implement those, right?
Right. Well, Citibank is providing on their website the history of returns for these indexes with the hedge in it, so people can look at how they performed in different interest rate environments. Right.
But it also mentioned that, there have been many periods of time that during rising rates, if it's good for equities and equities are performing, it doesn't necessarily mean that it's bad for corporates or high yields, right?
Right, that's right. Well, usually, of course, corporate and high yield debt, the credit spreads, could be narrowing, right? Because of the better, because their revenues are improving, their profits are improving, in a good.
Not to say that's guaranteed,
no,
but
right. That generally happens, right, in this phase of the economic cycle.
So, are you finding in talking to advisors that are really looking for strategies that, they not necessarily are confident in what they might be able to implement themselves, but be able to diversify their strategies in these type of structured strategy products that may work?
Right. I think that people, along with the move to more sophisticated beta strategies, alternative or smart beta, there's plenty of room in the interest rate side as well to have these strategy indexes that that actually give you the types of exposures that you want. In this case, long credit, short Treasury. And so we're really excited about the opportunity to offer, these types of solutions. And I think that it also is good because the portfolio managers have had to lower their duration by moving into these shorter duration or floating rate products. So this really gives them an alternative to that.
Sure. But as always, you got to do your research.
Absolutely.
And you folks provide a lot of education on these products, right?
Yes, and there is a market environment where this sort of strategy does underperform, and that would be in a real financial crisis like we had when you had credit spreads widening,
Absolutely, right?
And Treasury yields falling in a flight to quality. So you do need to be aware of that.
But if folks go to ProShares.com, they can find out everything about these products, right?
Right, and the benchmarks are on the Citibank Index website.
Great, great. It sounds exciting.
Great, thank you.
Thanks, Joanne.
Yep.